You shouldn't, he's a doctor or she's a doctor, so here's my money. You still
Yes.
have to do due diligence. And it was eye opening, the economies of scale that you can achieve with bigger properties. It's incumbent on the syndicator or the fund manager to have realistic numbers. Investors should be able to ask them how they arrived at those numbers. If they won't tell you that, then what won't they tell you about the property you're investing? We all want to make money, but we don't want to make money to the detriment of anybody. This should be a win-win-win situation.
Welcome back, investor. Got another episode of Passive Income Adventures today with Dennis Bethel. Hello, Dennis.
Hello.
This one is going to be a mock interview, as if I was saying, hey, Dennis, we may invest in your multifamily fund. Like we run a fund of funds. We do mostly hard money here at Rise Capital for those of you who are first time listeners. And occasionally we need a little bit more growth than we're getting on debt, and we need some tax benefits that we're not getting from debt. And so we occasionally will bring out equity deals to our investors. Our specialty is finding great multifamily deals. And Dennis, that's what you do, correct?
That's what we do. Yes.
Right. Tell me a little bit about that. Where are you calling in from? Give me a little bit of your history, and we'll just go through what investor due diligence should look like when they're choosing an operator to invest with passively.
Yeah. Great. I'm the founder of Nest Egg RX. I come from a multifamily background. I actually am a trained physician, an emergency medicine physician. Worked 18 years in the broken healthcare system and was able to extricate myself through real estate investing. And I am in Central California is where I'm located. My business partners in New Orleans,
Okay.
and we invest in a lot of Southern markets in the United States. What we do is we go out and buy 80 to 200 unit building properties and hold them for mid to long term and holds minimum 5 years, and we'll underwrite them for 10 years. And as long as they're producing cash flow, we like to hold them for our investors to give them stable and conservative cash flow, and then with the expectation that there will be an appreciation pop at the end.
So mostly like a 5 to 10 year deal horizon, or what's your average deal cycle?
It's probably 7 years, but 5 to 10, yes. I spent 13 years with a moderate size acquisitions and asset management firm solely based in multifamily, and our deal cycle was 7 years on average.
I think the bubble got people used to that 24 months, 36 months, because we're going to turn it around and the cap rates are compressing. And so we could just sell it in 18 months and we didn't have to do much to it. So I think that even 10 years is much more realistic based on historical. But a lot of people got into this during the bubble. So I feel like they have warped expectations.
Oh yeah, they're thinking they can buy something and turn it in 3 years, and so take on fixed rate debt and not have to deal with defeasance or yield maintenance. And instead of doing the fixed rate debt, they go with floating rate, and they're able to minimize some of those penalties with the expectation that they're going to be able to turn some outrageous profit in a 2 or 3 year period. And there are
Mhm.
parts of the real estate cycle in which you can do that, but you're taking on an enormous amount of risk. And I think, unfortunately, a lot of people are seeing that now.
Yeah, underperforming or just total losses. We had one that we invested in passively. We had a very micro portion of the GP. It just did not do well. At floating rate debt, same thing. It was just a perfect storm. They closed on it probably 2 months before the rates just spiked, got up to the rate cap within a few months of purchasing it, and basically spent the renovation money to try and keep the mortgage afloat. It was pretty rough. And so I think that's what a lot of people are seeing now. But we're definitely in an environment where we're needing to hold things longer. And I love that you brought up the loan because that's the biggest risk. You're not going to get a foreclosure. Like Dave Ramsey says, 100% of foreclosures are on properties with mortgages on them. You can have a tax foreclosure, but it's pretty close to being true. So I feel like saying, okay, we'll have a yield maintenance or something like that. That's to get you to keep the thing longer. Right. And so people were not wanting those because they wanted to flip them in 24 or 36 months. And now we're having to go back to some of those more stable loans, but you have to hold them longer so that you don't get charged basically a prepayment penalty. Can you talk a little bit more about that?
Yeah, with a model where the bulk of compensation comes at the back end. That's proper. You really should align your interest with your investors, and you shouldn't do well unless they do well.
Yes.
But when you do that, it does create an incentive for you to try to hit your hurdles and buy and sell because you can't unlock your compensation, or at least the bulk of your compensation, until you offload the property.
Mm.
And there have been times when I was a passive investor in deals where it's like, why are we selling this deal? I'm getting great cash flow from that. And so it really depends on what kind of investor you are. If you're looking to appreciate your money as fast as possible, get it back and do it again over and over again, fine. You're probably younger in your lifespan, but I deal with a lot of people who are looking to replace their current active income with passive income. And I'm dealing with people that are middle aged and upper in a lot of situations. And so they're really looking for cash flow to live on. And
Mhm.
so in those cases, what your model looks like and what you're doing for your investors. If you really have got a property that's cash flowing nicely, it's hard to go back to them and explain why you're selling unless you're getting an outsized gain or something that, wow, in my mind, that property hadn't even appreciated to that value. I could turn around, I can do a 1031 exchange, and I can even do better with the money. Then, of course, you're going to do that. But yeah, but saw a lot of people turning around because it made a lot of sense for the syndicator to unlock their carried interest and get their back end fees when you wonder if that's what was best for the investor or not.
I'd love to dig in. We're using some terminology here that I want to dial it back just a little bit for the beginning investor, but let's back up even a little bit more before that. If we're talking about due diligence and how the operator really makes such a big difference on the loan, the financing makes a huge difference, but executing the business plan is really all on the operator. I think that you're a perfect person to ask because of your medical background, marketing, and personal branding. I find that the people who tend to be very flashy and they've got the private jets and the fancy cars, like sometimes we can see through a lot of that and we're like, that's not really what we're going for. But tell me about lab coats because I find that there's an authority just built into somebody wearing a white lab coat or being a doctor. And I find that other doctors tend to invest with doctors because they're doctors. And I'm sitting back looking at that thinking, how does that make them a good real estate investor? And how much does that lab coat play into who you're choosing to invest with?
You hit on a couple things. One is I've been involved with at least one deal that I could think of, probably two deals, where we bought underperforming properties from a group of doctors.
Yeah,
And
pretty
then
cool.
way back when, many years ago, I lived in New Mexico and my first multifamily deal was a 70 unit property, one block from the University of New Mexico. And what it was a buddy of mine, an ER doc, came in and talked to all the other ER docs about investing in this property. So five or six of us invested in this property and it did well. I
Mhm.
didn't make money, but the frustration I had is that my ER doc friend was running it and as good a guy as he was not a real estate guy. And I knew that we were not as efficient as we should have been in that deal. So that's the one side of it. The other side of it, I think, is that because by and large, most doctors, if not all of them, are accredited investors. They
Okay.
find target for a lot of people looking to invest with them, and a lot of people abuse them. And so I think there's a comfort level in dealing with other doctors. Now, doctors are no different than anybody else. There's honest people and a little more fluid honesty in that community. But by and large, they go into the profession for good reasons. And so I think there's a little more trust on that level. Now, that's fine. I think to start out trusting doctors at the beginning is fine. But just because you're a doctor or just because you're dealing with a doctor doesn't mean that you need to forego your due diligence. You shouldn't, "Well, he's a doctor or she's a doctor. So here's my money." You still
Yes.
have your due diligence. Largely, if you're going to invest as a passive investor, you are going to be trusting the person that or the company you're dealing with. And so you do your due diligence up front because most of these are structured in blind pool funds, which means is I say, hey, we've got a fund. We're going to get 5 to 7 properties. This is what the property is going to look like, but I haven't got these properties yet. And so you're going to trust that I'm going to do that work. And so you do that diligence to trust because what happens if we're going after 5 properties? The first 3 look great. And then all of a sudden they bring one in a rust belt state with declining population, high unemployment, and you're going, "Why the hell did you bring that?" My buddy, he needed to offload this, and we had the liquidity, so we did it. You got to be careful who you're investing with, and you can't just invest with somebody because they've got an MD or a DO after your name if you're a doctor.
Yeah, because it's essentially a financial business. And a lot of doctors, I don't know if complain is the right word, but doctors in private practice, especially, will talk about how they didn't get any business training in medical school. And now they're expected to just go out and run a private practice and have all the business skills that they need in order to be able to do that. So I feel like it's pretty commonly understood that medical school is not business training. Dentists complain about the same thing. They're running a private practice and they have to learn the business on their own. So I'm not saying that the credentials, like, you don't need a business degree to do what you're doing, but you have to show that you've demonstrated the ability to either self-teach or the experience that you're able to go in and make these decisions. Like, we're smart people, like, You could be a multifamily real estate investor. Maybe I could be a doctor, but I didn't choose to go that route. And there's something about physicians that kind of gets that automatic stamp of, wow, this guy's smarter than me. I think it's really important. We're just using that lab coat example, but it's really important to look at the marketing of the personal brand and ask yourself, what is this person trying to convey? It's a door opener, and hopefully they're not trying to use it as the close. It shouldn't
Right.
be like, invest with me because I have a really cool brand on
Well,
Facebook.
and if you find you're investing with somebody because they have a flashy personality, and I could name names, but I'm not going to,
Yeah.
or they're nice YouTube videos or whatever else, that's fine. I don't discourage you from talking to that person, seeing if their business model aligns with yours, seeing what their track record is, and doing your due diligence. But if you're going to skip those steps, then don't invest in this. It's important. Who you
Yeah.
invest in is important.
Yeah, other than the loan, I can't think of anything. People say location. I think location is a big one, but I vet the operator first, then the location, and then we'll look at the loan because that's such a big deal. And just making sure their math is done correctly. So before we jump into that, let's do this in the order that we would do that. So we're looking at the operator first, then we'll talk about the kinds of deals you do, the locations you do them in, and then we'll dive into the spreadsheet, so to speak, and get into the nitty gritty on the numbers. So there are two things I want to know when I'm working with an operator. One, I like to know your personal story. And two, I want to know your experience. Experience is very important, but I like to know that we have shared values and that I don't feel like I'm not believing what the person is saying when we're talking about shared values. Oh, yeah, I love kids and dogs and charities. That sense of authenticity, genuineness. Is that a word? But that genuineness of what they're telling you is true. So tell me a little bit more about your decision you got into multifamily investing. You were still working as a physician. You're like, I need out of this, led you to say, hey, this is my ticket out of this broken system. Because most of the physicians I talk to, they love doing what they're doing. They love helping people, but they eventually need to go back to 50% or get out of it completely because of insurance administration,
Yeah.
like, laws, all of that. So tell me where that came from for you.
Yeah, I think that's really true. I think a lot of physicians get into it because they want to help people and they love that. And then they get in it and it's not what it used to be. You have so many third parties, whether they're insurance companies, attorneys, hospital administrators, telling you what to do, inserting themselves in the patient physician dynamic. And it gets really frustrating and burnout really happens. So I went into emergency medicine. It was, for me, it was a calling. It was exciting. And I was young, didn't mind working overnights and doing those kinds of things. But as time went on, I got older, I got married, started a family, and we found out that my wife has the BRCA genetic mutation.
Oh,
So
yeah, mine has that.
yeah,
Had that.
there's a 70% lifelong chance of getting breast cancer and 40% lifelong chance of getting ovarian cancer. And our
Yeah.
kids, unfortunately, have a 50% chance of inheriting that.
Okay.
And this was before Obamacare. So Obamacare made it so that you could not discriminate based on pre-existing conditions. And it was a
Mhm.
great thing. But before that, it was like, will I be able to get her the healthcare that she needs
Yep.
going forward? You can say, hey, you got this genetic mutation, so we're going to deny coverage of that. So I was in residential real estate at the time. I had mostly fourplexes and I was doing fine, but I wasn't going as fast as I wanted it to be. I was burning out in emergency medicine, knowing that I couldn't continue to do this forever, but feeling like I needed to be sure that I could take care of my family. And what I noticed is that people that I was involved with or the people that I saw were doing much better in commercial real estate, whether that's at that time, whether it was retail, office, or multifamily. And I just had the opportunity to invest with another emergency room physician. And I was living in New Mexico at the time. And we bought a 70 unit property, one block from University of New Mexico. And it was eye opening, the economies of scale that you can achieve with bigger properties, how you could with my fourplexes, because I was leveraged on them, I was always one vacancy away from negative cash flow.
Yeah.
And so scrambling to get that thing full so that I can make a couple $100 a month. And that wasn't the case with the bigger properties. And at that point, it was just an aha moment to me. It's okay. I need to figure out how to divest in what I'm already in and get into this. And so that's what I did.
Okay. Yeah. It's quite a story. I know, like I said, my mom had BRCA too, passed away from ovarian and breast cancer, but only one sibling tested positive for it. But I remember when I was getting my testing done, I tested negative, and I just remember thinking, like, I can't have this information get out anywhere. If it comes back positive, I can't risk it. It was before all of that, same time frame. And I had just been
Yeah.
denied coverage and my husband lost his job. And they picked him up as an independent contractor and we were renovating a house actually. And we had some old toilets that we took out and I broke the toilets up with a sledgehammer to throw them in the dumpster. And I just grabbed a piece very carefully and I was like, don't touch the sharp edges, no gloves. I'm like, I'll just throw these chunks in there. I hit the side of the dumpster with it and it bounced back and just basically tried to slice my finger off. Like a
Oh,
year later, we're trying to get health coverage and I got some stitches. It's got some weird lack of feeling in there, all that. And they were wanted to know my doctor appointments from the previous year. And this hand specialist was one of them. And they denied me coverage because I got a boo boo on my finger. So you're telling me if I got cancer, I would have no
right.
coverage. He's like, "Make the rules." So that was kinda like my first those 2 experiences, just figuring out, like, I can't count on any of this kinda stuff, and it started to change our trajectory of how we were planning for our lives and how we were thinking about stuff that could happen. When your siblings are testing positive and then getting cancer, it was those kind of experiences, like, wake you up and make you think differently. So let's go down your so you got into it. Let's go down your experience pathway. Tell the listener, you started out with some of the small multis, hated running them, no economies of scale. They didn't really treat it like homeowners and they were treating it like renters, but then I didn't have the economy of scale to like really make money. And the vacancy was killing me. And it was a lot of work to get it loaded. And my property managers were not doing a very good job and they were too expensive. And so it's just, I can't be doing this anymore. So sounds similar to your story. So where did you go from there?
From there, I made it my mission that I was going to figure out the multifamily space
Okay.
and paid mentors and learned the business and got to the point where I could develop markets because markets to me are very important. I can find the nicest deal in a bad market and not do well. And I can find a mediocre deal in a really good market and do well. And when I'm really good, I'm talking about population growth, job centers. I'm talking about a diversity of job centers. So it's not all focused on one industry that if it goes under, you're screwed. And so I could develop those markets. I could find property management and then I could develop deal flow in those markets. And my ability to do that was noticed by a boutique upstart company. I was working as like an independent contractor with them. As I was doing that, I was extricating myself from emergency medicine. Wasn't so much that I'd gotten out at that point. I was just cutting back. Older partners in my group were noticing it. How are you doing this? You have young children. When I had young children, I was working a lot more shifts than you are. And I was like, I'm investing in real estate and it provides passive income. So I'm supplementing what I'm making so I don't need to do as many shifts. And so and that sparked curiosity in what I wasn't going to do in the industry, which was raise capital. I
You're already
started,
raising capital, whether you want to or not, everybody's raising capital.
well, it wasn't my plan to do that, but
Mine either, but here I am. Do it.
I started having people ask me about it. So I was happy to share that with them. At that time, I didn't own my own company. So I'm saying, this is the company I work with, and I'm making those introductions.
Mhm.
And I got my residency director in there. I got partners from my current job in there. You got family members in there. You really have to believe in what you're doing.
Oh, yeah.
Do that. I definitely believed in that asset class and continue to believe in the multifamily asset class. So while it wasn't my plan, I was happy to do that. And I almost got to the point where I felt like if I don't share that, I'm doing them a disservice.
Yeah.
And I started my website's been around since 2012, but we didn't start our own fund until last year. My website was dedicated just to educating people along the way of what I was doing and share that information. There's so many doctors that I met who are burning out, who are getting tired of it. And now private practice is starting to go under as private equity starts buying up hospitals and healthcare. Yeah, they're coming up with ridiculous mandates. You have to see so many patients per hour. It's, what are you talking about? You don't even know anything about medicine. You're just private equity. But when they're the boss, they're the boss.
Oh, that's like the reverse of what we were talking about. It's like you don't invest with someone just because they have a lab coat, but also someone who doesn't have a lab coat inserting themselves into the medical business and telling them how you're going to run it. That's interesting. It definitely, oh man, I think both spaces really attract people genuine, people who are going to learn the business, people who are really going to do it right. And then the
Yeah.
opportunists are just looking to try and make a quick buck and never really want to learn the underlying business behind a private medical practice or behind a
Right.
multifamily. Talk about, especially with physicians, like not only you guys are running businesses, private practice, but a very complicated, heavily regulated business makes it even more difficult to navigate. And so I feel like doctors who can successfully do that in their private practice, sometimes they'll have a PE company. I see this happen a lot in dentistry, the roll-ups and
Yeah.
telling dentists how to do their job and a lot of frustration there. I don't know if it happened with them first or what, but yeah. So just learning the business fundamentals underlying, I think just like a doctor can learn multifamily, so can a PE firm learn how to run a medical practice. But it's actually not that common for people to really dive in and love what they're doing and really just dig into every little detail and get out in the weeds. Because as an active business owner, that's what it takes. Yeah, interesting parallel there. Okay, so tell me about what you were doing between, say, 2015 and when the multifamily bubble burst, or right before it burst in like 2021 or 22.
We were in an acquisition phase, and so we were really acquiring a lot. None of the properties that I was involved with when I worked for this other company did poorly. They were all profitable. Some were better than others, but starting in 2022, I think it was, we you would see, and at that time, I wasn't involved in operations with the company. I was involved in primarily capital development by that time. But you get a new property, you'd see that the cash on cash, and this is something that people don't always understand if they haven't been in the business, is that you make money in multiple ways in multifamily. Typically, when people advertise their projected returns, they'll advertise this is the annual cash flow we think you'll get or the yield. But then there's a back end appreciation, assuming the property does well. Doesn't happen until you sell the property or have a liquidity event, maybe a refinance, whatever it is. But what I started to notice is that we started to see the underwrites come through and the projected cash on cash returns were declining. They were getting
Yeah.
smaller and smaller. And it's like, why are we even offering these properties to these people? And so at that point, it became apparent to me that even though I was principal in the company, that my management goals and my management style was no longer congruent. And
Mhm.
it seemed it was getting time to get out and move on. I saw other companies that acquiring at that point. They were saying, hey, we're in a hyper expansion phase of the market. These are overpriced properties and it doesn't make sense to pick them up. Some companies were very particular about what they were picking up, and some didn't buy properties for 2 or 3 years.
Yeah.
And I think that's hard to do for a company that has bills to pay and all the rest of that. But ideally, you're working with a company that profitable and they can pay all of their bills with just their asset management fees. So they don't need to churn for acquisition fees. They don't need to churn for disposition fees. They don't need to churn for those things to pay their bills. And I think that's a really important question that a lot of investors don't ask of these companies is, hey, if you didn't buy another property for the next year or the next 5 years, can you maintain your level of operations with just asset management fees? Or would you have to start laying people off?
Yeah. I've never heard that on a question like due diligence checklist, right? I don't think I've ever heard that particular one. Like, how do you guys make money? Because acquisition fees or on the back end when they have to sell it, I'm not interested.
Yeah. Asset management fees, I always think of that as keep the lights on money. So if they're managing the assets, they should be making enough money to pay all their bills. And if they're operating in the red, consuming their asset management fees, but they need extra, and they go out and sell a profitable property that, yeah, it's profitable, but if you'd held it for another year, another 2 years, you'd have made a lot more money. But then that infuses a $500,000 disposition fee that helps them. Then their interests are no longer aligned with yours.
Yeah.
And investors don't know that. You kind of have to be in the business to see that and to question that. And doesn't always make you popular when you question that in the company. But
Yeah. We're going to tell you what you want to hear. Let's pretend that we asked that question. For somebody who hopes that the property is going to perform and that they can pay all the bills, keep the lights on with just asset management fees alone. And you say, hey, what would you do if you didn't buy another property? So how are you getting that through that BS meter when you ask a question like that? And they'll be like, oh, our properties always perform or whatever.
yeah, it's a tough one. You can ask the questions And I guess you could break that down. And I've never done this myself, but you could break that down into, hey, what was your profitability last year? What was your number? And some of the companies, if they're in the Inc. 5,000, they have to report that number. And so you can get it that way. But if you ask them, what's your profitability? And they say, last year we brought in $3.5 million. And you ask them, what's your expense? And they say, well, our expenses were 3 million, then they're profitable. And if they won't tell you those numbers, I can understand to a degree why somebody would want to keep their business numbers private. But if they won't tell you that, then what won't they tell you about the property you're invested in?
Yeah, I think that's a good point. It's, oh, our properties always perform. That's not data, right? From a data science kind of background, you need to be like, okay, give me some numbers. Show me your numbers from last year. What's your burn rate? Because that you can actually base on actual numbers rather than just them telling you stuff.
Yeah, and that's something, especially with moderate and bigger property companies, is some of these companies, they get a new deal. And what that means is they send out an email. They say, hey, we got a new property. You want to invest? Give us a call. Some other companies will take the time to create a webinar and show you some data and the rest of those things. But very few of these companies will open up their spreadsheet. And not that every investor wants that. Some investors are like, hey, I've invested with you. I trust you. I don't need to see that. But other investors, if they want to, why aren't these companies open their spreadsheet and say, hey, this is what we've underwritten. This is our purchase price. We think the rent growth is 3.5% per year. Historical rent growth is 3%. We arrived at this number based on this data. And why aren't they opening the spreadsheets and showing people that? To me, that's the level of information I would want to see.
Yeah, I agree. But at the same time, when there's a lot of information out there, and you tell me how you deal with this, I want to educate my investor on how to make good decisions based on financial data and
Yep.
experience. So let's jump into that. Let's take our journey down a little bit farther. And you decided to leave, assuming you had some sort of a non compete period, launched your fund. You got to skip all the bad years of not acquiring things. So you launch your
With
fund
yes, not so much with the other business, but yes.
with the previous one, yeah. So you're educating, you're talking about your website's there to educate. I find 2 things there. One, they don't have time because they're like, wow, this is a lot of information. And I don't need this to be a second job, a hobby, side hustle, whatever, just to be a passive investor. And 2, when you do give it to the passive investor, they're like, I don't want to learn this. It looks like a lot. And now I feel completely incompetent and incapable of making an investing decision because I don't understand all this stuff. And so, how do you handle that? Because I believe transparency is what builds trust. So, I want to be transparent and give them whatever information would that they need. Like I'm going to open the books. But at the same time, confused investors don't invest. So, how do you give them lots of information without that incompetence of, "Oh, I'm never gonna understand this, or I don't have time to learn this."
I've talked to so many people through the years. It's really a spectrum of investors. There are people that want to know everything, and there are people that want to know nothing. Like, hey, I
Yeah.
trust you. Just do what you do.
Well, I'll invest with you now.
There's everything in between. So I let the people that don't want to know so much know that here's the information. I'm happy to go through it with you. I'm happy to have discussions with you. You don't have to look at it if you don't want to, but I have it for you and you can make an appointment on my calendar. We can talk through any of this. I have talked to several people that are so data oriented and have so much analysis process that they're never going to invest. And I've even told a few people, I don't think this is right for you because you're the type of person that wants to go on a daily basis and look and see how your investments are doing. And you really can't
Yeah.
do that in this world.
No, private markets.
Yeah.
We're not even updating our numbers that often in private markets.
But when you're investing in stuff for 5 to 10 years, it's like a marriage. It's not a one night stand. It's not a date. It's not those people who are out there. And I like to think that there's not a lot of them, but those people are out there who are trying to trick people into investing. It's not going to work well for them long term. You don't want people investing with you, even if they have the money. You don't want people investing with you that it's not right for them. They're not going to be happy with this investment. They're going to come back questioning every move you do. So you want to make sure that they get the level of information they need. And you need to be honest with people. And if you really don't believe that something is right for them, you say, I'm not sure this is right for you. And so I think for some people that's hard to do, but in the long run, this is really just about helping the right people. This is what I do. If what I do resonates with you and you'd like to come along with me, then you're more than welcome. If it doesn't, that's okay too.
Yeah,
I just
there's
want
Oh, go
Go ahead.
ahead. No, now I forgot what I was gonna say, but
I was just going to say that as soon as you start chasing money runs, you just really have to position yourself knowing that, hey, there's a lot of people this can help. And it's just about matching what I do with what the person needs. And there are other people it's not right for, and that's great. That's okay. If I can help them find what is right for them, then that's wonderful. I'm happy to do that.
yeah, I find myself more worried about incompetence or inexperience than I am worried about fraud because, like you said, very few people get up in the morning and say, I'm going to go have a flashy marketing campaign, defraud people out of their money, and then put it in a Cayman bank account and flee the country. Those guys are out there, but they're pretty rare. I think the bigger risk is the deal just isn't going as well as they thought. And then either it doesn't perform or even loses money, and then in extreme cases, they end up committing fraud by misappropriating funds, moving them from one deal to the other. Those kinds of things like that. That happens. But I think what is more a concern to me is just this deal just didn't do what it said it was going to do. And so the experience of the operator is that's where it comes really in handy. Have you done what you're going to do before, and how many times was it successful, and how many times was it unsuccessful? So we got one recently where they gave us a track record of every single property they've ever owned and what they paid for it, when they sold it, what their profit margin was, and you're going down, it's a little like in a percentage on ROI. So it's a little percentage, a little bit big percentage, like 4 digits or 3 digits. And then they got one in the red. And I thought, wow, like this is not that common. Have an actual property resume here in the pitch deck.
It's not. It really isn't. Like I said, transparency is an issue in our business. It really is. I don't understand why.
Yeah, you're doing well. Let's share it. But even if you lost money on some deals, kind of like that, like everybody has a 5-star review and you're looking for a 3 or a 4-star review so that they don't look fake. Yeah, I don't necessarily want to make sure that they've lost money before. That's not necessarily a requirement to invest with them. But like you said, some deals do better than others, and to be very transparent about your experience because that deal track record, like that, it's almost like the king piece of data, at least for me, as this person doing what they said they're going to do. Is it their farm, their expertise, and can they do it again? That's really what I'm looking for. Real estate's a rinse and repeat kind of business. We're not
Abs-
chasing the next big thing or the blue ocean. We just want
ab-
to execute.
Absolutely. And I think that the ones that I've seen where they give you their track record and they lose money and they're willing to tell you, this is what happened on this deal. This is what we learned on this deal. I think that can actually build trust with people if they understand it. Even with this, so there's so many syndicators right now who are just treading water. They've paused distributions because they went into floating rate debt and they have caps on that. And as the interest rates ratchet up, the caps cost more. And
Yes.
so they're using that money instead of distributing the money. I can't believe how many of these syndicators, instead of just saying, listen, we messed up. We got fixed rate debt. We shouldn't have done it. We'll never do it again. This is what we learned from it. This is how we're keeping your investment safe. And we believe that in so many years, this will turn out. And this is the lesson. Instead, I hear things like, nobody could have predicted that the interest rates were going to go this high. The Fed is they keeping the interest rates high when they should be dropping them. And it's like, are people buying that? Because it's why don't you just say made a mistake? And this is what I've learned from it. And this is what I'm doing every day to protect your money and your investment.
Yeah. Oh, that's good. Well, we should put that on a t-shirt right there. I always say investors want to know 3 things. Like 1, when am I getting paid? 2, how much am I getting paid? And 3, how likely are you to pay me what you say you're going to pay me when you say you're going to pay it?
Absolutely.
Yeah, perfect. Okay, so let's talk about the numbers. Let's briefly mention the locations that you invest in. And you mentioned like choosing a market. So we already talked about how that's so important. You want population diversity, but just give me like a little piece about, you said you invest a lot in the South. What markets are you targeting in your fund? I'm assuming you have a few picked out and you're going to only buy assets in those few markets.
Like a lot of people, we like the Texas Triangle. I'm looking at a lot of San Antonio right now. We like a lot of Southern markets. We like Atlanta, but we're also watching. If you look at the number of new construction, a lot of that was in the South, disproportionately in the South. So we're
Yeah.
watching the absorption rates right now to
Okay.
make those properties after this year. A lot of the way construction works, there's permits, there's starts, and there's completions.
Okay.
So we're getting a lot of completions right now, but what we're seeing is we're not seeing a lot of permits and starts happening right now. So even though a lot of delivery has happened last year and is going to continue to happen this year, we believe that there's not going to be a lot of new supply for several years after that.
A little bit of a gap.
Yeah. So the question is, how quickly is the stuff that's being delivered now? How quickly is that getting absorbed? So we're watching that, but we still like those markets. We like them because of the job growth. We like them because of the population growth. And a lot of that fuels, if you boil this down, and I hate to get too simple, but if you boil this down, when you're talking about market rate properties, you're talking about your ability to raise rent. There's really three things. Can you increase profits? Can you decrease expenses? And can you increase retention? Way you make money in this business. But the biggest of all of those things is rent. And can you raise rent? And are you in a market where that's not rent constrained, where, you can raise rent and keep somebody in with the ability to still pay their bills, have discretionary income, all the rest of those kinds of things. So those are the markets we're looking at.
Okay. Okay, perfect. And I like all those markets. I like the North Carolina, I guess the Research Triangle, Atlanta, Texas Triangle. We're from Austin. We really like that area as well. Those are the kind of places like we do most of our hard money loans in Salt Lake City because this is not the market where I want to own stuff. This is a market where I want to flip stuff. And it's not a great multifamily market. If you want in here, you got to get into new construction because there's just not a lot of inventory. So that's what I like about those other markets is they actually have inventory to be retrading, whereas here in Salt Lake City, a lot of cranes on the skyline. We're the only one of those is mine. And so I feel like to get in here, you really have to be into new development. And if you want value added, this is not the place to be. So we do a lot of flip money here. And then our multifamily is elsewhere because it's not a great market for that. So market's very important in understanding like, where are you versus supply? Can I even find a good deal here? I'm not saying no apartment buildings trade here, but it's very competitive because there's so few of them. So markets are very important. And let's talk about when you're diving into a spreadsheet, you open up a pitch deck. Here's my thing that drives me crazy about syndicators in general, especially capital raisers. They don't want anybody to ask them any financial questions because they don't really understand even what's in their own pitch deck. This drives me nuts. Let's imagine medical sales is the example I always use. One of my very first customers, or very first investors was medical sales. And I said, what do you do there? He's like, "Oh, I sell devices." And there are a lot of times that when the surgeon is installing the device, I'm standing there in the operating room with him, telling him where to plug everything in because I know the device much better than the surgeon does. Right.
Right.
And so he needs some technical help there. And so he's smocked up and masked and in the operating room for a huge part of his job. And that impacted me very heavily because in tech sales, which is where my husband comes from, their head sales guy knew the product just as well as the developers because he has to go out and push this. And so those two experiences to me were like, I better really dig deep and learn these numbers. I need to be a specialist. So if it's in the pitch deck and we're expecting a lay person to understand that pitch deck and we ourselves don't get it and are afraid to be asked questions about it, to me, that is unacceptable and a big, big red flag if they can't even answer questions about what's in the deck. So let's go over what you put in the deck that you feel every investor needs to know on the financial metric. Let's start with some of the things you mentioned earlier about loan types. And you mentioned IRR, cash flows, things like that. Just give me a rundown of what every investor should know.
Yeah, all those things are important. And what I think a lot of syndicators focus on is average annual return, cash on cash. And it's really common in this industry. I do it too, but you have to disclose it. And that is that what you report on your pro forma, what you either returns you think you're going to get is gross returns. And as a physician, I get my competitors' ads on Facebook constantly.
Mhm.
It was advertising 25%, 30% average annual return. And you're thinking whether you're a core plus, value add, or new construction, 30% is not common after tax, after fees. That's not a common number. And so they're reporting gross numbers. So I think that it's okay to report gross numbers as long as you disclose that. Fortunately, not too many people are disclosing that. So when a competitor reports real numbers, say the average annual return we're projecting is 15 to 17%, and that's after tax, after fees, it's hard for them to compete with somebody that's reporting 30. The unsophisticated, why would I take a 15% annual return when I get 30% with these people? And think if people are, if syndicators aren't disclosing that, that's a problem. I
Okay.
think you have to disclose that. I think you have to disclose your rent assumptions and how you got those assumptions. I can tell you any number. I can make any spreadsheet look good. Most of the times when I underwrite a property, the first pass it looks mediocre to poor. And then you say, okay, is it in the market that I'm interested in? And is it in the submarket I'm interested in? But it's not hitting the returns that I project. So then you work with your property manager and say, you're going to be managing this property for me. Am I missing anything on my underwrite? And they can come in and say, oh, there's 5 competitors in this market who have upgraded units of similar size that are getting X number of dollars higher than you. So if you go in and do a value add play and add $5,000 a door, you should be able to get this rent. We know that because we're managing 5,000 doors in this market and this is what it is. Oh, okay. Then I can adjust my underwrite, but you can't do that if you don't have the on the ground knowledge of that. You can't just do that. And unfortunately, some syndicators will go in and underwrite unrealistic numbers. And the average investor doesn't know that. They just know that's their number is their number. Hey, they say that I can get 20% on this. That's what they know. They don't understand how they got there. And I think it's incumbent on the syndicator or the fund manager to have realistic numbers. Investors should be able to ask them how they arrived at those numbers. And if you ask them, hey, you think I'm going to, you project I'm going to get 20% per year for a 5-year hold, you're going to double my money in 5 years. How did you come up? What rent growth are you underwriting? That shouldn't be a problem telling you that. Now, maybe you're talking to the sales guy of that company and he or she doesn't know that number offhand, but the answer shouldn't be, I don't know, or trust us. The answer should be, we're underwriting this based on these facts. Here are 5 properties within a 1-mile range of the property that are getting these rents per
Mhm.
square foot. And we believe we can get those rents. And if they're not willing to tell you that or able to tell you that,
So comps, that's a big one. That's what I'm hearing. Like the data that goes into the spreadsheet is what predicts how good the data is that comes out of the spreadsheet. So I'll give an
absolutely.
example. We have we're looking at some deals and occasionally we'll go do our own research on CoStar or something like that. And
Yeah.
most average investors don't have access to CoStar. It's very expensive, but we're using things like DeepSeek or Perplexity where we're actually able to do some research. We upload AI has changed our ability to do this because we can upload our docs and be like, hey, what is the actual rental comp in this area? And occasionally they'll say, oh, CoStar is not accurate, especially in smaller towns. CoStar is famously inaccurate, which is fine. I'll give you the CoStar can be inaccurate. Show me the alternative data that tells me why you put something different than what CoStar is saying into your spreadsheet. I want to see what property manager pro forma, what properties are they running? I like to see actual comps with the numbers of well researched. And it takes a long time to do a good comp sheet or chart in a pitch deck. This is what this one's charging. This is what year they were built. It's a similar size to ours. It's nearby. It's in the same school district. Those really important factors that run good comps and being able to say, is this doing what they say they can do? And I also don't invest with somebody the first time they're buying an asset in a new market because everything, all your assumptions can get thrown off because you don't know where the school district boundaries are or whatever. So to me, I don't think that's necessary for everybody, but for me, I want to see really good comps and I want to know that they have experience down the street.
You're right. AI has changed a lot and we use it quite a bit. I still like the old school method. In the old days, 70 to 80% of your renters already live within 5 miles of the property. So if
Right.
you fly out to a market and you get in a rental car and you drive 5 miles in each direction around the property, and you're looking for what the retail looks like there, the entertainment centers looks like there, restaurants, bus stops, what your residents are going to be using. And then you find your competitors and you go in
Yeah.
there. Hey, I'm looking to rent an apartment. Can you show me one of your units? What do you charge for it? And it's tedious work. If you do that work, it pays off. It really
Yeah.
does.
Yeah. People ask what exactly define due diligence. And I said it comes in layers. So level one is believe whatever BS the broker told you. Just believe it and then see if this is something you want to take a deeper look at. Level two is do some of your own peripheral research, see what you're finding, disprove the broker. If it still has legs after that second round, you're going to go to third round, which you're going to drive out there, fly out there, whatever, make an offer. Or if you're really familiar with the area, go ahead and make the offer. And then the offer is accepted and you start asking for bank statements and tax returns and bills and all that kind of stuff. So it just gets more and more layered. The farther down you go, the deeper you get into due diligence, the more original data you're going to have to show you that I have these on something, on bills, on bank statements, on whatever, rent returns. Like we walk every single unit while we're under contract, like these types of
Yep.
things. We're not do that on pass one, right? But we're planning on making 3 to 5 passes at this thing. And each one we're tightening down how much information we're going to have. And I want to see, did you get
Yeah.
utilities?
Yep. You can paper up a letter of intent on a lot of the stuff that you do from your home office or from your business office, but you better not be turning, if you turn into a purchase and sale agreement, you better not make your earnest money hard money until you have walked every unit. You've done a complete rent survey. You'd be surprised how much you get a trailing 12 of financials from the broker, and then you do your rent survey and you go through every folder of
Yeah.
every renter. It's not the same. There is discrepancy there.
Yes, and I'm glad the days are behind us of earnest money needs to go hard day one, or we're not even taking this the day one that PSA is, and I've already spent thousands of dollars on an attorney. I've already flown out there for thousands of dollars. So I'm pretty locked in at that point from we have sunk costs. But they want 100, $250,000 of earnest money hard day one. I mean, you just couldn't buy a property under those kind of conditions unless you were really farming an area and you already had one down the street and you were able to act fast. That's who had the advantage in that market. That's gone, which makes me so happy because rough to
Look,
call.
a rough times. We had I want to say it was a 350 unit property that we were offering on in Houston, Texas. And it was good property. And it was between us and a Chinese firm. And they literally put $2 million hard day one. It was like,
Yeah. Wow.
I'm not going to do that with investor money. We can't do that. And so you lose those properties and it just kills you.
Yeah. But at the same time, you're like, when the competitive environment looks like that, sometimes you just feel like, I'm going to take a break. I'm not going to compete in this market because this is not my investing thesis to play fast and
Yep.
loose with my money or my investor money. So we set out, I think the last property I bought, multifamily was 2021. And the last RV park project we bought, mobile home park, was in 2020, end of 2023. We're very slow right now. We're just not liking the deals we're seeing. We don't feel like those old models are really addressing reality. It's been rough finding deals lately.
And that's really what you should do. If the market doesn't meet the moment, then you need to have the ability to take a pause. And those companies that don't, you have to wonder why. It's like, why did you show me properties with a 5 to 8% cash on cash return 5 years ago? And now you're showing me properties with a 2 to 4% cash on cash. Why are you doing
Yeah.
that? You got to wonder, well, oh, we think that appreciation is going to be just the same when we sell the property. Yeah, but I'm a yield investor. I'm looking for cash flow, and it seems like this is a much skinnier deal just based on that number alone. And I think it's important that whether you're a money allocator or an operator or whoever you are, that you can pause operations if your model's not being met. And it's okay to change your model, but you better change your model because it's the right thing to do, not because you need to do deals.
Yeah, and honestly, it's like what you were saying before when companies are pausing acquisitions because they're making enough off asset management to pay bills, make payroll, all of that kind of stuff. I feel like in the same position, our passive income from some of our small rentals, selling our small rentals, repositioning that into hard money loans. Like, I don't feel like I need the money from because one, I like the cash flow on the lending
Yeah,
because it's more immediate, it's higher cash flow. Now it's a lower total return. But I felt like buying a multifamily the cash is keep the lights on, but the play is appreciation and depreciation. And I am not seeing anything reliably appreciating that I feel like could pay its bills while it's appreciating. And I have so much depreciation that we've carried over hundreds of thousands of dollars that we've carried over that we can't use, even though we're real estate professionals. We have
right,
so much that I feel like I don't need the depreciation either. If we sell properties, we honestly just pay the tax on them because we have so much depreciation carried forward. We can't even use it all. And so for
right,
me, like the same thing that you just said, like I don't need we don't even usually charge acquisition fees. I don't need that. We're doing on our passive income. It changes the way that you make decisions. It changes a sense of urgency and it makes you so picky. I wonder almost to a detriment. I'm picky, but at the same time, it's the same thing you said is the person running this business solvent? Can they
yeah.
bring their own liquidity into the deal if it's not doing well? And do they need this money or do they just love running the business and it has to make money to justify, but they're not in this for a quick buck or an acquisition fee. They're in this because they really love operations and asset management and positions and dispositions and all of that that goes along with it.
And if you're an investor, how do you find people like you? You want to be able to find the people that are in this capitalistic society. We all want to make money, but we don't want to make money to the detriment of anybody. This should be a win-win-win situation. This is something the investor comes first. And I think there's a lot of companies out there that believe that, but unfortunately, I think there are some that don't.
Yeah, or there's some that believe that, but then they can't actually deliver on that conviction because the deals that they have are just this is like a losing battle from the beginning when you get something that's just outside your buy box or that's not working. I feel like the best time to buy is the lead up to a bubble. So in a bubble, bad time, earnest money hard day one, those days are over. And just going to be starting to see some good deals here, but I feel like there just aren't really enough of them. And I don't care right now. Yeah, but I think some of our investors really are looking for some depreciation and they're telling us like, we're ready for an equity deal. And so I feel like we're looking not for myself, but like you said, the investors come first. So sometimes it's difficult for me. We're like, how much money are you putting in this deal? I'm like, none. I don't need more depreciation. I-
Right.
I'm not looking for that. And they're like, oh, if you're not investing in it, why are you asking me to invest in it? I'm like, you have very different goals than I have. And you're in a
Right.
different life position. You still have jobs, all of that. So for the first time listener, we left corporate basically at 48 and retired early after 5 years of intensively investing in multifamily and rental homes. And we got the freedom within 5 years. And in the 2 years since we've left corporate, our goals have really changed. So cash flow is king. We're not chasing growth as much as we were. Like I said, we have so much depreciation we've carried forward. So my situation and my investing choices aren't necessarily everybody's because the situation can be so different.
Yeah. You had said something. If you study the NCREIF, which is the National Council of Real Estate Investment Fiduciaries, if you look at their property index, and they've been keeping data since 1978 on all of the commercial real estate, with the exception of hospitality. I
Mhm.
think they started keeping track of hotels in 1982. I think if you look at their property index, there's been three dips since 1978. And you have to be careful because there really is no national market for real estate other than the lending market. Beyond that, every market is local, and you have to look at the local markets. We're in a dip right now. Buying during a dip and then riding recovery and expansion can be very profitable. What we're dealing with now is high interest rates, and you're also dealing with sellers who are coming to terms with their property losing 15 to 20% in value and selling at a higher cap rate, which a lot of them don't want to do. On the other hand, the way this industry works is most people get a 5, 7, 10 year loan that has a balloon payment at the end. And when that balloon payment comes up, unless you have the liquidity to refinance it, to pay it off, you're going to have to sell. And whether you like the cap rates or not, unless the bank works with them, extends their loan or does something else, they're going to have to sell. And so I agree with you. I think there's some real opportunities are going to come. We're not quite to the point with sellers who bought in the wrong phase of the market and paid too much, understand that they have to take a haircut, but we're getting there.
Yeah, we got beautiful fixed rate stabilized loans on before the interest rate hikes. So they're great loans for 5 years. So those
Yeah.
great loans for 5 years that we have on a couple of our properties, we're 3 years into that, right? So the next year to 2 years, we really need to seriously look at refinancing those. I'm seeing rates start to come down. I'm seeing lenders start to lend. Our hope is that we refinanced them right before the rates went crazy, giving us 5 years of this craziness that we got to avoid, and then just see what we're going to get on the other side. But that unpredictability of refinance rates and cap rates at the sale, that's where a lot of risk is introduced into equity investments because it's not just profit sharing, it's also loss sharing.
Yeah.
So as long as the investor understands and diversifies enough, I think there's so much opportunity. We retired from our job. We have 6 kids. Like we had a lot of income we needed to replace. And so we retired
Right.
from our 5 years off of playing this stuff smart. So I feel like if you want to be that aggressive as we were and that active as we were, it requires a lot of faith and due diligence. And if you want to be more passive, you just kind of have to, and honestly, the less you want to know, the more you need to diversify.
Yeah. I agree.
Yeah. And
Yeah.
interesting. Love talking shop with other multifamily investors and just the state of the markets, data deals. Make your crystal ball prediction over what you see your fund doing over the, say, the next 2 years.
Yeah, we're in acquisition mode. So I think we're going to be buying properties. And I think this phase of the market, you can do really well in value add, but I think you can also do really well in core plus because as the market goes up, even if you're just solving minor problems in attractive properties in good neighborhoods and writing rent growth, I think you can do well as long as you hold it long enough. And then, of course, value add adds a little bit of risk, but it also adds a little bit of security if you know how to do that business. If you don't know how to do the business, you may be adding a little more risk. On the spectrum between core plus, value add, and new construction, value add is considered more risky than, say, a core plus strategy. But I think almost any of those strategies, maybe not new construction, but almost any of those strategies are going to work in today's market.
Yes, it reminds me of the saying, pigs get fat, but hogs get slaughtered. I think this is the time right now the pigs can get fat and the
Yep.
days of the greediness and the hogs got slaughtered in 2021 and 2. And we'll maybe see another round of slaughtering with those loans that are coming due. I don't know if those are hogs, but just if things don't recover enough. But honestly, right now, it's time to just play it smart, play it safe. There are lots of great deals out there and just get the bubble and you, listener, I'm talking to you, get the bubble out of your mind. That was an unusual period. Those numbers are not coming back for probably another 6, 8, 10 years. And it's time to look at what's in front of us and make decisions based on what's available currently and where we see things going. I understand this is not a speculative business. This is a boring rinse and repeat, stable cash flow, good appreciation on core types of projects. And don't be swinging for the fences. Honestly, like this is not crypto. So just everybody just needs to take a deep breath, understand the deals are here, they are coming, but they may not look like they looked in 2018 or 2020.
I think you hit the nail on the head. There's opportunity out there, but investors are probably the most reluctant I've ever seen them because of what happened with floating rate debt, what happened with their cash flow drying up. You see it on the news, but you see it online where, multifamily went through a period to 2022, 2023, where rent growth was either flat or negative. Oh, they're overbuilding. But what you don't see is behind that. Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. Most people are fearful. This is the time to invest, but it's hard to raise capital because you have to convince people it's time to invest. And I'm not in the convincing business. And this is what I do. If you want to come along with me, then do it. If you don't, that's okay too. I'm not going to try to twist your arm to invest, but savvy investors see it and they really see this as a time to get in.
Yeah. And it's tough to compete right now, even just with the index stock market. It's an all time talk about overvaluing, right? I think when things are high valued, it's like maybe take a little off the table and it's time to diversify, buy low, sell high, or buy well and sell high. I interviewed recently, I think the episode 1 or 2 before this was the founder of E Trade, and he now runs a publicly traded fund in emerging markets. And he said, he doesn't call it raising capital for a publicly traded fund, but basically that's the message. Raising capital is a bear right now. I'm like, if the founder of E Trade is struggling with just
Right.
getting people to move into diversified options, it's rough. So you, as the investor out there, it's time to get educated. It's time to get ready. Like it's time to start preparing yourself to make moves. Start looking at deals because you're not going to invest in the first deal you look at because you don't know what you're looking at, right? But as you educate yourself and you look at more deals and you meet more operators, eventually when one comes, you'll be able to act quickly because you've already done the prep work. So now is the time to get ready. And so I want to continue to introduce you to great people out there. Dennis Bethel, who is doing what he's supposed to be doing to give investors a great deal and doing his due diligence and not try and talk you into anything. We're just here to solve problems. If you have a problem we solve, let us know. Oh, we can help you. Dennis, how do people get a hold of you after the show?
You can contact me at Dennis at Nest Egg RX, and our website is nestegrx.com.
Perfect. Are you accredited investors only? Do you have any
Yeah.
crowdfunding or private 506B? You can't talk about
Oh,
506, but
we'll succeed.
perfect.
So it's not our rule, but we follow it, of course.
Exactly. And you know what? I don't have a problem with it. I used to really have a problem with it, but then they allowed the sidecar of the crowdfund and the Bio60. I'm like, unaccredited investors have options. And I really feel like the crowdfund is the safer option for most unaccredited because the minimums are much lower. And for
Yep.
me, I have no problem saying for this size, these 5 and 6 figure checks that we're asking for, I'm fine saying we do accredited only. And if you're not accredited, no problem. We can introduce you to some great crowdfunding options. I've interviewed some of them on the show before. So reach out if you want to talk to me. Partnerwithrise.com/Emma will get you right on my calendar. I can connect you with Dennis or anybody else we've interviewed on the show and help you find good options for you. Because like I said, we only solve a narrow set of problems. And if we don't solve the problem that you have, or we can't serve you because maybe you're not accredited or something. Let us make the introductions that you need to help you get educated so you're ready to make some good investing decisions. All right, Dennis, appreciate you being with us, spending some time with my listener, educating. You really do enjoy teaching, which I think is so important. So appreciate you coming on the show.
Yeah, Emma, thank you. I had a great time.
Awesome. All right. I'm looking forward to talking to you, listener. Jump on my calendar and tell me about your next passive income adventure and let me help you figure out how you're going to pay for it. Till next week.